My discussion today is going to be more of kind of a big picture discussion. I've got 4 or 5 topics. Some of them will be review topics, ones that we've covered before, but sometimes it's good to just kind of review where we've been and and where we are right now. So let me go ahead and share my screen. And my first topic is going to take us back a ways. I haven't done this one in a while. But the purpose of this particular topic, and let me get a different look here. So what I wanted to share with you is, what historically happens when we get above the red line. So for those that are new to market structure edge, the way that I think about the green line and the red line, oversold conditions, and you can think of it as overbought conditions, or the market is just getting stretched. That's another term that I like to use. And what I've done in the past, and I'll briefly walk you through this spreadsheet, is I've put together a spreadsheet looking at, when have we historically gone above the red line? What's happened to market trading during that time? And what this spreadsheet will show you is, let's take this instance right here. It goes above the red line. What's the market performance during that time? What's the market performance 2 weeks afterwards? So that is what I'm about to share with you. And this data goes from 2020 through 2024. Don't worry, I'm not going to share every line here with you, but I just wanted to go through some big picture concepts. So what you see here on this spreadsheet is when we go through the red line, and then the number of days that we're above the red line, what the performance is during that time period. And the performance can vary. This was as we were coming out of the pandemic. You can see that was lights out performance. Most of the time it's very predictable, 1%, 2%, 60 basis points. I'll just slowly scroll down. You'll get an idea of what this looks like. 2021, it was worse, during a few periods, 20 basis points, 10 basis points. You kind of get the idea of what it looks like over time. Generally speaking, when you get above the red line, returns start to die out a little bit. Look at 2021. 2022, of course, was more of a bull market. When we went above the red line there, performance was pretty bad in some cases. Look at that, down 9% during June of that year. Big picture, and you can see it as we're scrolling down, big picture over time, and I mentioned this in a note a couple of days ago, 50 basis points. So when you're above the red line, gains tend to level out. That's a central tendency. There will be periods where it will be greater. You saw that in the spreadsheet. There will be periods where it'll be less. Average time, not 9 days above the red line. And ironically, if you look at the return 2 weeks afterwards, it's exactly the same. And I need to update this spreadsheet. This goes through September of last year. But 50 basis points above the red line, 50 basis points 2 weeks afterwards. So I wanted to share that with you. And once again, just getting a perspective, what does it mean to move above the red line? What generally happens? And just look at what's happened here in these points that you see during the last year. Back in April, oh, excuse me, let's see what that period was. That was back in July of last year. You can see market actually started to move a little bit lower. Market gains level out, market gains level out, the gains level out here, gains level out here. And you can see why it's 50 basis points. Over time, you just tend to lose some of that performance. It's been in a little bit of a momentum market. Once again, the gains level out. I did a little bit of a not a spreadsheet, but a PowerPoint slide, because to me, it's a kind of an easy way to track what's happening. And specifically, what I noticed a couple of days ago is what is happening going into month end so far this year. And we'll do a year to date here. So what is happening going into the month-end time frame, and then what happens afterwards? And you can see it here. Coming into month-end, sentiment had been rising. What happens afterwards? Well, sentiment declines. In this case, the gains kind of leveled off. Look at these patterns repeating themselves. March going into April, sentiment climbs into month end. What happens afterwards? Sentiment declines. Of course, we had Liberation Day, market came under a lot of pressure. What's happening now? Well, sentiment climbs into month end. Sentiment's not yet moving lower, probably does soon. But look at what's happening with short volume in each instance. Short volume rising January into February, short volume rising February into March, short volume rising March into April, short volume rising in this cycle again. And that's what you see on this uh, particular PowerPoint slide. And you can see it right here. The returns here were the only ones that were close to average. As sentiment declined, the market kind of moved sideways, and we were down 50 basis points from January month end until here, which was February expirations. Of course, the market saw significant declines in this episode and even more in this one. What happens this time, I don't know, but you can really see the same pattern playing out over time. Here's that short volume rise with this particular pattern. And I mentioned I'm sharing kind of a lot of big picture concepts. To me, it's important to look at historically what's happened and try to paint some pictures so we don't go into our trading without some precedent from the past with what could potentially happen, during this particular cycle. I'll take you back to one other episode here. This was August of this last year, and I couldn't find the exact date that I wrote the note. It was a couple of weeks ago, but what I was looking at that particular time frame, I was noticing that sentiment was declining going into expirations. It was one of the few times where we had seen a sentiment basically bottom at expirations itself. And what I noticed coming out the other side is that not only did sentiment, start climbing then, but then the market did as well right into August month end, and then the market fell afterwards. I don't know if that's going to happen this time with the market falling afterwards, but there was a precedent there that we wrote about, and I think we talked about it in one of the demos as well. And you can see, it's played out exactly that same way for this particular cycle. One other item to talk about from a big picture perspective, and then I'll actually turn it over to Tim. I didn't even take, half of the 20 or 30 minutes, Tim. The last one is just where we're at right now from a market volatility perspective. And you've seen this slide a couple of times now, but once again, if there's anyone new, these are some of the recent market cycles when we had kind of difficult conditions and how we came out of them and where we're at right now. So 2018 to 2019, market really fell apart in the last quarter of that particular year. We did have short volume that fell by about 5.5%. The market got its legs during a yearly transition, December to January transition. Sentiment climbed and the market took off. In 2020, of course, very different conditions, but we had significant declines, obviously, there in the beginning of the pandemic. Short volume initially went higher. We didn't recover until short volume went down by about 16%. Once again, sentiment was fully oversold before we started to see that recovery, but you can see well below the green line, sentiment starting to recover there in 2020. 2022, this was a very interesting year. And as time is going on so far this year, I see more parallels to 2022 trading. What I'm seeing developing is just these periods where you're going lower, then you get a rally, then you go lower, then you get a rally. It has kind of that feel to it. I don't like using the word feel from a quantitative perspective, but it seems to be tracking some of that same type of tracking activity. What happened that particular year after just having a very difficult trading year? Market participants, in my estimation, just got spooked towards the end of the third quarter in September. Short volume rose dramatically by 15%. Finally, shorts got covered. Once again, sentiment was oversold, and then we rallied the rest of the quarter and into 2023. Lastly, this is where we're at right now. This data is through yesterday. You can see that sentiment rise. Once again, we were very oversold. We have to go back to 2022 to see conditions like this in terms of being this oversold. But notice what's happening to short volume. It's rising, in fact, dramatically so right now. And during the last year, there's only been 2 time frames where we've been this high from a short volume perspective. You go back to this time frame right here. That was in September, and market had moved a little bit lower. Short volume was very, very high. We got just a dramatic short covering rally, basically going into the election, coming out the other side, and you can see what happened to the market. We had a dramatic rally in the market. The last time that we had short volumes this high, well, you have to go back to March. What happened in March? Well, Liberation Day, and the market tanked. I have no idea what happens this time, but you can see during the last year, there's only been 2 time frames that we've been this high from a short volume perspective. So with that being said, Tim, I will turn it over to you for now.
Thank you very much, Brian. Mm-hmm. I may not have enough material. I mean, I was counting on you to go to. No, I'm just kidding. I've got 5 things that I'd like to cover, and whatever time that takes, we'll do. Hey, Chris, fire away, please. The floor is yours.
Yeah. Thank you. I was going before you leave this topic. It's really great to see the month end. I was surprised to see the 3 days at 6.6, the rising short volume. The month begin. Also, could you talk about the SPY? Because it's reacting. I was surprised to see how it's moved as well for this month end, month begin.
Agreed on both counts. Yeah. Do we know that this is going to happen? No. That's why I say we just check the data every day. But we were talking about this internally as well. So looking at SPY, and I have an answer for you, Chris. I mean, there's always an answer in the data. And that doesn't mean it's the only reason, but we can certainly see it. So to your point about SPY, this is what you get in bear markets. My view of what is occurring has not changed at all. I am not at all surprised that the market is doing what it's doing. We talked about it before, that you could have much has happened in 2022. There was a long rally off of the steep early declines that year. And then we had problems again. So, what happened in the past does not mean it will repeat itself in the future. But certainly looking at this data for SPY, these kind of conditions where we hit 1, we've done that. This is a very long stretch at 1. And then to have, as you point out, now it's very strong. And then I like to go just get a read on, it's only anecdotal, and I'll show you what I mean. What's causing that? Who's responsible for this? And one of my points to cover today is what the trading yesterday told us, because it's pretty clear to me what that indicated. Of course, we're market structure geeks. This is how we think about it, and we're not always right about these things, but we often are by looking at the mechanics. And backing this up, here's what I mean. Here in latter part of 2020, didn't get there. We didn't hit ones, but boy, look at this period. And this is why we look at what's happening now, and we look at what happened in 2022. And what you could conclude, you'd say, well, it's one of two things. Either it's over, in which case we never had a beginning, or the beginning of this is much bigger than 2022. And look, it's got nothing to do with I'm agnostic from an ideological perspective about this data. I just read the data, right? We just read the data, look at the patterns. And you would look at this and say, this is probably this year's version of this, in which case we've got more to go. Now, I don't know. It could change. But having spikes in SPY is very much in keeping with what happens during these periods. The absence of spikes tells you that it's a large cap blend kind of market. There's value in growth, and you don't have a lot of dips or spikes in supply and demand. And realize 65% of U.S. equity assets exposed to the market managed by BlackRock, Vanguard, and State Street are in passive large cap blend models. And so when you begin to get spikes like this, I mean, that's clearly it's an indication of volatility. But to me, it's also an indication that there's a high probability that we are in this kind of environment, not this kind of environment. I mean, what else would you conclude? Now we'll see. To your point about this extended period at 6.6, and it could rise. If we take a daily read, it actually dipped a little and has risen for a couple of days. So that could happen. It's unusual, but it's not unexpected, particularly coming into month-end options expirations. And this is very telling. There's been no covering event. There was none of this. There's none of the stuff that occurs when a period of tumult concludes. And you can see it all through the slides that Brian just covered. Every time we are coming to the conclusion of a period of tumult in the equity market, there is an event like this, where whatever it is, it's right into March and year-end options, or quarter-end options expirations. Index rebalances were right here as well. So that wasn't surprising, that you would have all of this come out of the market because everybody's trying to get square right at index rebalances. So my point out of this, it's not surprising, and I would feel less concerned about what comes next if there had been a covering event, and there hasn't been. The other shoe, but we've talked about this a lot, the market is heavily dependent on artificial liquidity. You can get rising supply that is filling demand, but then there will be a consequence from that. I was on a panel with a guy who used to be at UBS, and he runs a firm that builds algorithmic strategies. And he said routinely 100% of the large orders in the market could be filled with short volume. That is supply that Citadel et al. Create, because you can't just find it. If the order has to get done today, the rules say fill the order if it's marketable, even if no stock exists. So you can have these kind of events where we know this is supply that is filling demand from whom. That's what we want to answer. But then there will be a consequence because the value at risk, everything's got to get squared. And if it's extended and there's a lot of movement in the market, boy, it could be a violent reset. I'm not saying that's going to happen. I don't know. The road to predictions is littered with fools and carcasses. So I'm not saying that I'm going to predict what occurs, but we certainly know the central tendencies. So to answer the question about from whom, this is what I like to do. It's a spot check, and it's not meant to be anything other than that. But if you were to poll this audience, where the audience is all of these tiles representing portfolios, I like to just go, look, well, who's leading the momentum portfolio? It's not fast trading, which is generally the case. It's passive money. And you go like, well, why would passive money, which wants an average price, be chasing prices? That doesn't make sense. Passive money leads mega caps. Not a big surprise. But you just scroll down through here. Passive money is everywhere. Active money leads big tech. interestingly. The stock pickers like big tech. The problem is stock pickers are net sellers. They lose hundreds of billions of dollars a year to BlackRock, Vanguard, and State Street. So it's not a contrail that can continue. It burns out very rapidly. And I'm not saying that's going to happen, but this is a very nice chart. We can see why tech stopped falling and has done very well here during earnings, because demand is rising and supply, while high, has ticked down a little bit. And that, stock pickers are doing that. They will do that. Good earnings, but does it have a carry through? Not if you don't have money. It's 10% of market volume. But you could go all the way through here, and everywhere you look, passive, passive, passive. Feed that into SPY. Gets used as a substitute a lot. Baskets of index futures. Strong demand there from passives. Well, why would that occur? And to feed into one of the core things I wanted to talk about, yesterday's trading, where you begin the day down, and then it continues down, and yet by the end, the Dow has moved over 1,000 points, just using that as an example. But the enormity of the move, and to finish positive, isn't what people think it is. I heard people say, well, started out, and people were very pessimistic about these tariff discussions. And then as the day wore on, their mood improved and they became buyers. That's not how the stock market works. It is not how the stock market works. That was money. These are people who are trying to mitigate their need to have the reference price at the end of the day, the last 10 minutes of the day. So you do everything you can with your hedging and trading strategies to try to make that happen. There was a Wall Street Journal article, I've mentioned this before. I know him, Jacob Bungie is the writer's name. He's on a different beat now. But he used to cover market structure, and he used some I think it was Morgan Stanley, what's called 605 data. You have to track how you handle order flow on behalf of T. Rowe Price, where the global head of trading is electronic trading is Met Kinect, guy I know very well. And he wanted to buy 2.7 million shares of this group of stocks. And Morgan Stanley put in orders for 300 million shares in order to get that done. All over the place, buying and selling in order to get this tiny little bit, because that's how the market works. So put that in context yesterday. What was occurring? Month-end options expirations. What happens then? People have to have their baskets trued up to the benchmark. They use banks. Banks sell that risk to someone else, like hedge funds, who will speculate in it to try to boost returns. And so the market does this whole move down and back up because that is forced buying. They're trying to get the weakest reference price they possibly could, but it's still finished up, right? And so then you have a carry through today. I don't know how the day will end. I don't know when the other shoe drops, but I expect it will. I expect that was not something somebody wanted to have to do, but it's very large. There are trillions of dollars benchmarked to these month-end events. And so it behaved very much like what I see in the data. This is passive. Who is it? That's the tougher part. Is it passive money is way out of whack? Is it the authorized participants, the big brokers who manage that process? I don't know. But I know that the purpose behind it is passive. It's not momentum trading, and yet we're getting momentum characteristics from it because it has to happen. And so just, these are important things to understand. Now, again, I don't know how the day will end. I'm going to be hedged. I wanted to point out, we'll talk tactically about what to do. Might as well do it now. What to do today. It's Mountain Time, 12:57. By the way, it's May 1st. I never said that at the beginning. May 1st, 2025 demo. How do you position yourself ahead of monthly jobs data from the government, which is much less reliable than the ADP data? It's got much greater volatility in it than the market. We could not rely on it as a model if that was the data we were depending on. But it's a tradable event, right? And I don't know. It may mean nothing, or the market could move. And is there any indication? There's high short volume. Demand is extreme. It's above the red line. As Brian points out, the market generally returns 50 basis points, and it's returned a lot more than that. So does it give it back? I don't know, but I certainly am going to have I will have an appropriate long short, probably a volatility trade. Those are, you have to be very careful about that. You have to be comfortable with, I'm not advocating that you do it. The volatility piece of that leg is the hardest. That's the thing that can hurt you. The long short's pretty easy. I look at where the market is and I will be biased short. Now I might have to scrap that trade because I think that the other shoe could drop. If I had to cover, if I was the party responsible here, I would have to sell some assets. And, how long do I have? Well, settlement's T+1. I don't have very long to get these things square. So tactically, that's what I'm thinking about. Last 10 minutes, I'm going to look. Where are things? And that's the price that I will want to use to set the last leg to make sure that I'm protected. So that's two points that I wanted to cover. Then one more. I wanted to give a little reminder about how you cannot time the day. And I'll share my trade Wednesday. So I set it Tuesday. I set a trade for, again, long short volatility. So long SPXL, SPXU, and UVIX. And I set them on Tuesday. And then by 7:34, I was out of those trades. I made 2% on my long side minus, or the short side minus the long hedge. So you back that out. It was a very good day. I'm very happy with that return. But then, of course, you watch the market and it could have made twice as much. Yeah, but that's where you can't, don't even look at it. You can't outcompete Citadel. During the day, Citadel rules. I'm just using Citadel, as I so often do, as the example. They have all the data, but their purpose and time horizon is a day or less. So mine was a day or more. So then I'm happy that I didn't have to compete with Citadel. And ultimately, I was very happy I got rid of the trade because the market did, to me, was forced covering. So it's a reminder. If you got the trade correct, you have it right, just take your gain and be happy with it. And don't come in and make a makeup foul, try I got out too soon, let's do something else. Don't do it. Don't do it. You'll consume all your returns. Just wait for the next opportunity to not compete with Citadel. Citadel will run over you. And so, I don't know if this shoe will drop today or tomorrow. I'm willing to take 1, 2, 3 days of risk around this period because I think it's pretty material. So we'll see. Last thing before we talk about what's ahead, and we'll wrap up here. Quick engineering update. Let me see. Joe, you asked about this. Somebody else asked about it too. Barry Norton, I don't know if you're here. You've long asked about this. Downloadable data from broad sentiment. I've discussed it with the engineer today. Should be doable. I also talked with him about putting the 5, 20, 50, and 200-day volatility reads for the S&P 500 in here. We got to figure out where, and how do you load it and how do you reference it and all that kind of thing. But they're both doable and we can do them. Which brings me, Joe, I don't have your questions in front of me, but you asked about, could you take the volatility instruments and maybe look at, 5 years worth of data and then compare to demand and supply and get a read and use AI for that. Of course, that gives me the cold chills because I don't want our IP in an AI engine, but it's data. It's not the IP. It's, it's the byproducts, and it's going to happen, right? Anything that's downloadable is going to end up in somebody's large language model. I'm aware of that. I don't love it because we have a unique take. We have figured out a piece of the puzzle, and I've talked with all the, Robinhood, State Street, talked with several people at State Street yesterday, Schwab, Fidelity, bunch of institutional people who are in obscure shops, but who know a lot about market structure, trading technologies. Those people speak the same language we do. And we do unique stuff with this data. So I don't know what it'll show you, Joe. I don't know. Those volatility instruments, to me, the only way you can play them are at these intersections. When the only reason I'm doing it is because we're right at one again. We have this, we had this. We had demand hitting the red line, high supply. We have demand above the red line, high supply. Does not mean that the market's going to tip over. Could. I mean, all I can do is play that, and I could be wrong because you don't know. But I'm not doing it randomly. They're only at these junctures where I will do that. The rest of the time, I prefer to trade the momentum daily trading ideas. This is just not it. This is too volatile for that. It's hard to get returns from the momentum portfolio, as many stocks as there are in it, because of the fact that we're at these critical junctures that can produce tremendous volatility and catch you out. And, the worst thing is nothing happens and you miss some trading opportunity in the momentum portfolio. But, you have to pay attention to those data points, which brings us, I think, last to, and Brian Wilson, feel free to weigh in, what happens next? We talk a lot about the new month, new money trade. Could that be part of this? I guess it could be. I look at the supply side here, and I don't think so. This is what happens when money is really coming into the market right around the quarterly rebalances and so on. So that then leaves us with one conclusion, that what is occurring here is purely between the very large ETF passive complex and the parties that supply them. And somebody is out over their skis, one or the other, and I don't know which one it is. And so I just, I look at what's next. My thesis, I'll repeat myself, is unchanged. These strong rallies, 15% rally for a lot of stocks in here, is what you get in a bear market. I continue to say that we're in these kind of conditions. It doesn't, again, I could be wrong, but knowing that those conditions occur in these kind of markets, just approach them accordingly. Okay, that's, I think, all I've got. Questions? Let's see. Did we answer
nothing to add, Tim? There are a couple questions there. One from Brad, Candace, and Joe.
Okay. Let's see. Brad has used price limit orders that sit in the level 2 and 4 order, but or are they just buy and sell on time events like payroll day? No, they are absolutely the indexed money, the money that is following a benchmark. All they're going to try to do is, like any asset manager, is keep their portfolios optimized. People have this notion that passive money merely follows the market, that all the other things are what determine the ups and downs, and passive money just is along for the ride, and it's not true. So ETFs, whose assets those are? BlackRock's. They don't belong to you and me. If you buy an ETF, you have no pooled claim on an underlying asset. Even if you ask Grok, it will say ETFs are pooled investments. That is incorrect. They're not pooled assets, which means BlackRock is managing those assets for its shareholders. And BlackRock wants to optimize them. So they're going to do the same thing that we do running models, which is we want to, I don't have it. Yeah, I do. Okay. So for instance, this is the Edge Momentum Take Gains portfolio, I call it. What it does is use momentum characteristics, 8 or higher demand, declining 5-day supply, and a number of other factors, only large caps, 20 billion of market cap or more, liquid ones. And it says, just sell everything in the portfolio that has a 2% gain. And it's astonishing how well it does. This is a 5-day or 5-year chart. It's very, there's some fluctuations in here due to certain outliers during that pandemic boom. that the
Can you
model
can you
picked up.
share your screen? Can you share your
Oh, I
screen,
don't.
Tim?
Thanks for letting me know, because I just start talking and I forget that I haven't shared it. Okay, so let me show you. Um, to answer that question, Brad, no, they're optimizing their portfolios, right? So, and they use derivatives a lot. That's why these monthlies, which involve settlement change, and month end settlement change, dailies, weeklies, no settlement change, speculative. That's why they're so important. So here's the data. This is a massive outperformer. This is our model portfolio. This is SPY. And notice that they're highly correlated because everybody owns the same stuff. The market behavior is incredibly correlated everywhere. There's 60% correlation in the NMS stocks right now, very high correlation, where a correlation of 1 would mean they behave exactly the same, right? So there's high correlation because we're all going to own the same stuff. So the only way that you can outperform the market is when you buy or sell something. It's not what. And so, what I was pointing out is that the portfolio, this was as of, I don't know, a couple of days ago, right? So the portfolio is pretty large, but what it does is, it anything that is up 2%, there were 2, it takes those gains, and then it adds up to 10 more things to the portfolio. And just doing that, the only exit criteria is that. Here's the exit criteria. Up 2%. This is what it looks like. If you put it into a JSON model, it says price close is greater than or equal to 2. It's a 2% gain. There are no other exit criteria. And doing that, taking the volatility of the market, dramatically outperforms the market if you're in large caps. But the correlations are incredibly high. So that's the same thing BlackRock, Vanguard, and State Street are doing. They're going to be optimizing their portfolios. Their ETF assets are ones they own. Index funds are Investment Company Act of 1940 pooled investments. That is why they can only price once a day. You cannot give different people different prices to people who have a proportionate claim on an underlying set of assets, right? That's the core thing. Okay. Any other questions, Brian? Any comments about what's ahead?
I think you covered in terms of what's ahead. Candace had a comment, just more for everyone, that we can use the HIPAA compliant version of Claude in terms of if you have sensitive data that you want to put out there. Joe has a question whether there's any way to distinguish between short volume due to actual shorting and short volume from manufactured shares.
And the answer is yes. In a sense, short interest would give you the shorting that is coming from generally conventional shorting. So call it 3%. Literally 90+% of it is something else. The classic shorts, like the fuzzy pandas. We helped a client through a battle with fuzzy panda, which is a short. Hindenburg, Muddy Waters, those kind of groups. A number of them have gone away because it's very, very, very difficult to do. And they don't understand market structure. Like, why can't you short something and why won't it go down? Because they don't understand that Citadel will run right over the top of you. If you can manufacture stock as a market maker, and then there's an investor who's trying to short it, who's going to lose? It's not Citadel. I can tell you that. So it's almost all of it is market making.